Welcome investors to monthly outlook on equities by Canara Robeco. Let us debate what has happened last month incrementally and how do we see market from here on. And there are certain key events that have passed both globally and domestically in last month, and they are going to have near term and medium term repercussions as to how investors look at Indian equities. Let me start with the first aspect, which is the global piece. Clearly on global front, the macroeconomics in terms of the worry that we had on inflation is gradually receding. There are all indications that on a 3 months, 6 months rolling basis, the inflation is coming down, and the 10-year G-Sec in US is actually reacting to it. So 10-year G-Sec in US has actually corrected from almost 5% to about 4.1% as on yesterday, and that's comforting given that the correcting cost of capital at some point in time will lead to the market flows, particularly the FII flows towards the emerging markets wherever there is a earnings growth differential. Having said this, the inflation still is not over there. So the cost of capital, when you look at it 1 year, 2 year basis, still remains high, and the liquidity tightening globally, particularly in US, continues to happen. What are the repercussions of these things for us as a country or as an emerging market? 2 or 3 repercussions, and which we have repeated in the past also. One is clearly your globe is slowing down. That's reflected in the way energy prices are also correcting, although they at the margin are also positive for India, but clearly the growth is moderating, and its impact is visible in the way certain, on a bottom-up basis, certain sectoral numbers are panning out, be it IT, be it chemicals, and some of the other engineering companies where exports is a large proportion. It is visible in the numbers. So first is clearly the export growth at the margin will keep moderating given that the globe is still slowing down. The US is still slowing down. Europe is largely in recession, and China, while not in recession, but is not actually doing anything great. So as a combination, growth moderation is likely to continue for a few quarters ahead, and it will have its own repercussions for exports and export-oriented businesses. Second, which at the margin is positive for us as a consequences of slowing growth or likely slowdown in growth in US and likely slowdown in inflation incrementally further from where it is as of now, which is already significantly down from the peak over last 1 year. There is an expectation that the cost of capital or interest rates will be actually cut at some point in time over next 3 to 4 quarters. And there are various projections. There are projections right from 25 bips to probably 100 bips by the end of the calendar year 24. And if that were to happen, the cost of capital equation starts turning favorable. It turns favorable for both the growth asset classes like equities, and it turns favorable for markets like India or emerging markets like India, where the growth in terms of earnings differential is sizable vis-a-vis most of the other emerging markets and developed markets. That is second. And the third is basically as again consequences of the demand supply mismatch and moderation of growth, you are having, despite OPEC cutting productions, the oil prices have been correcting gradually, and that to India is a very, very positive thing, particularly given that we are anyways not dependent so much on exports, and at the same time, but we are significantly dependent on import of oil. And if the oil prices actually stay around $70-75 where they are today, it gives you a lot of cushion in terms of the external funding or balance of payment as well as trade deficit. So that's where we are. So 3 key takeaways. One, the growth is slowing down. Second, the cost of capital has started declining, which is positive for growth asset classes. And third, the energy prices have corrected, which again at the margin, at least to some degree, as long as they are actually above $60, $65, $70, is actually at net positive for India. So that's the external piece. Now moving to the domestic piece, there are 2 key events, 2 or 3 key events that played out over last 1 month. Clearly the top of the charts was the election outcome, which was far better than what the market was anticipating, which clearly indicates or actually increases the probability of the political stability. And when you get political stability, certain policy related sectors as well as certain cyclical sectors, be it the infrastructure, be it the public capex, be it the real estate, be it the capital goods, be it the anything and everything that is related to public expenditure, the policy environment is likely to continue. While the numbers based on fiscal deficit, how much government spends will keep going up and down, and the growth rates will change, but the political continuity will ensure that cyclically the investment part of the economy might continue to do well. That is one. The second event, which is more from the earnings perspective, earnings have actually panned out fairly well during the last quarter. Predominantly, the earnings growth were driven by domestic cyclicals as well as energy basket. Even if you exclude energy basket, the numbers were generally good. So those are the two macro or broader aspects that have happened in last month. One gives you comfort on structural story. The other is more on bottom basis. The numbers are actually chugging along well. Having said this, if you look at most of the other aspects in terms of macroeconomics, they continue to fare in a very good zone, be it tax collections, be it the inflation numbers, be it the current account deficit. You take the auto numbers, cement numbers, real estate numbers, most of the macro indicators remain kind of either neutral or positive. So that's the macro part of the economy. And coming to the third part, which is more directly relevant for our discussion, is to how the earnings are playing out, where the earnings are playing out, and how do we see those earnings actually panning out over next few quarters. First is clearly, as I said earlier also, the earnings have grown significantly better than the estimates. If you take first half, the only worry in earnings still in my mind is effectively the earnings are still driven by significantly by the margin expansion rather than the volume expansion. So when you actually try to slice and dice the earnings, your earnings are predominantly present in domestic cyclicals, which is okay. So when you look at the earnings, where the earnings are, cement, real estate, industrials, hotels, hospitals, financials, auto, part of consumer discretionary, these are the places where the earnings are generally good. Whereas the export oriented sectors with IT, energy, some of the commodities, and the domestic low end consumption, be it the low end four wheelers, be it the low end housing, be it the staples, be it the low end consumer discretionary, these are the places where the earnings continue to kind of struggle, which only means that the part of economy which is probably top 10, 15, 20 crore people continue to do extremely well, whereas the bottom of the pyramid continue to suffer. They have still not come out of the cash flow or balance sheet shocks that they experienced during COVID and post that because of the inflation. Our hope is as inflation cools down, that part of the consumption basket will start participating in terms of the earnings recovery. So that's one way to look at the earnings. Second, which I said, which is little worrisome, is that predominantly first half of financial year 24, earnings were very strong because you had margin expansion across the domestic cyclicals, because last year same first half the earnings margins were fairly low. You got the commodity benefit, so margins are high. In second half, we need to have volume growth playing out, which is playing out in certain sectors but not necessarily in all the sectors. So when you look at the sectors, basically the cement, the real estate, the public infrastructure, these are the places where you see fairly even credit growth on bank side, you see fair bit of volume growth, but it is not very homogeneous across the sectors. That's how we are looking at the earnings. Having said this, earnings still at aggregate level remain in a healthy zone. Financial year 24 is expected to be about 22-23% earnings delivery, and financial year 25 is expected to be about 15% earnings delivery. On that, the market is now with the recent leg up post and pre-election in the anticipation of positive outcome and then actual positive outcome, the market has moved to something like 21 time financial year 25 earnings. That's a fair zone in our view, unless and until incrementally earnings growth keeps surprising on upside. Having said that, just at the cost of repetition, the structural, while tactically the market might look in fair valuation zone, from a structural perspective, the balance sheets of corporates, banks, eventually government and household, all are on positive side, particularly on banks and corporates. So one should expect the investment cycle to continue and the baton to be passed on from public capex to private capex eventually post-election. And banks are there to support the growth. So structural factors remain extremely in a conducive zone, probably one of the best that we have seen in last 15 years. And second is gradually from a technical perspective or from a global perspective, India continues to stand out as an economy among the emerging markets where the earnings and capital efficiency is far better than the other large geographies, particularly China. And given that the FIIs who are particularly very light or they have sold net, at least the large cap part of the market, one should expect that pre-election, post-election, gradually that heterogeneity or that continuous buy sell every 3 months change in the direction should move to probably neutral to positive direction in terms of how FI look at your country. And if the political stability comes back, of course, a lot of them would want to allocate more money. So these are the two structural aspects. One is more fundamental, bottom of balance sheet story, and second is more basically political stability and differential in earnings, and thereof FIs wanting to come to your country are likely to play out in the valuation. So expect little bit of a fronting of multiples because this is a cycle. This is earnings growth cycle, this is a credit growth cycle, this is a business cycle, unless until we get surprised negatively in the central elections. And if it is cycle, you are not going to get market necessarily at a very cheap valuation. So that's where we are tactically. A little more consolidation expectations, structurally far more constructive given the aspects that we debated. In terms of market caps, clearly given the demand supply mismatch, it looks like the large caps, larger mid caps, relatively liquid mid caps, that's a place which is far better priced in terms of valuation as compared to the relatively illiquid, or as you keep going down below 10,000 crore market cap companies or 15,000 crore market cap companies. Is sheer basically demand supply dynamics that is playing out. So there is a lot of upfronting of returns that has happened in pure illiquid small cap mid caps. So to that extent, we would for a few quarters to come, we would prefer the large caps as well as larger mid caps as compared to the pure small cap as a category from our allocation perspective. That's it from our side as far as the last month is concerned. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.